Going on, everybody? Good evening. Welcome in. Hey there, Josh. Welcome, welcome. Welcome in, Charles. Evening, Rodrigo. Nice, Arcon. You gotta love it, man. That's the way to go. Oh man. We're gonna get started here in just a couple minutes. Sorry for being a little late. I couldn't get Discord to open up on my computer for some reason. So must have been some new update that was angry with me. What's going on, Shy? I'm doing well. How about yourself? Thanks for asking. Yeah, you like that excuse, Archon? I thought that one was a pretty good one. Comes up by 4A. Sorry, I'm just typing up one last message, letting everybody know we're getting started. All right, cool. Gotta get this last thing typed up. Doing great. Some PLTR profits today. Awesome. Yeah, definitely a good day on that one. That's for sure. Let's see what they do on there. I mean, it was like up 10%, I think, at some point. So certainly not a bad day. Let's see. Yeah, right through where you want it to with that retest to that 9. Yeah, that one looks like it wants more, doesn't it? Ever since that move up on earnings, it's really just held up rather nicely. I mean, above this 27 area, it's definitely got some room. Let's check this out real quick. Yeah, I mean, inching above right where it needs to. This big volume shelf here on the weekly, finally clearing that on some increasing volume, and we're only just a little over halfway through the week, so definitely looking like it's set up for more. PLTR, an interesting one to be watching throughout the rest of the week. Also interested in ARM. They have their lockup period on shares expiring. I think it's on the 12th of March, and pretty much like 90% of the float is locked right now. So definitely will act as a significant catalyst coming into it. And it'll be interesting to see how it behaves following that, the end of that lockup period. So I'll be watching into that. All right. Well, it looks like we got most of who was going to be here tonight. I know I recently did a lecture on the Greek, so maybe a little bit thinner of a crowd. That's all right. We'll answer this last question before we get into it. Apple. Yeah, I mean, you're asking if I see Apple bleeding more. It hasn't been able to hang on to that 200 daily. That's obviously a big issue, but coming into a rather important level here, right around the 165s, 167 area to 165. So it's coming into a spot where you really got to be paying attention to it, at least for a more significant bounce. We zoom out, look on the weekly, generally moving back into that same larger pivot, still well above the weekly 200. So not really anything to be too concerned about just yet. But very interesting to see that it stalled out perfectly right around that 200 spot. And just a lot of negative news on it recently with kind of that slowdown in China sales and, very clearly in a downtrend. I mean, we have open gaps across the board with really no sign of buyers now, but it's not something that I would be incredibly bearish on, so long as we react nicely to this 165 area is really kind of that last line of defense. And below that, you got to be looking down to the 150s, really. I mean, without even looking at the chart, if it loses this significant pivot, 150 is really that next big level to be watching on it. And you could look at pretty much any time frame and see those reactions off the 150 area tend to be rather significant. I mean, this is pretty much one of the more significant pivots, at least as we were moving throughout 2022. So yeah, something to be mindful of. Lose that 165 in the larger term. I'd be expecting to move back down to that 150, but not something that I'm particularly bearish on. It's actually one that I'd be interested to see if it catches a bid here in the next couple of days, considering how well the Qs have held up throughout this entire pullback. Yeah, I mean, you got Apple pretty significantly lower, Tesla, now Google starting to crack a bit lower. So a lot of these bigger tech names moving lower, yet we're not really seeing that reaction out of the Qs, which can mean one of two things, right? It can mean, that increase in breadth, which is absolutely something that's been happening, and maybe a little bit less significance of some of these big tech names, at least in the short term, right? I mean, you have semis pretty much dominating the market. These momentum semi names, NVIDIA, SMCI, AMD, really every single one of them has led things higher. But to address your comment, no, 150 in reality, right? If you're a long-term buyer, this is a place where you want to be considering those buys here down to support down to the 165s, right? The people who are buying up here obviously are not regretting that, and it didn't really make sense to be a buyer up there as we're sitting below that swing high in the first place. But yeah, I mean, really though, I mean, you lose that 165. If you're buying shares, a move down to 150 is only really a 10% drop, which would be a place for you to add more anyway. So if you're really a long-term buyer, I think you should welcome that idea, but that's just my 2 cents. What makes me like PLTR this week? Yeah, I mean, it's not a watch list about, or not a lecture about my watch list. So I'll probably end it with PLTR here, but real simple, in my opinion. You take a look at the 9 and 21 EMAs. You got a positive trend ever since this earnings move higher. That gap was defended, never filled. So obviously a significant move there. Buyers in complete control, right? Every single one of the above average volume days is buying. Today, you got that positive news on that, some military contract that they received with a move above all the recent swing highs on the highest volume since this earnings move. Again, setting higher lows sequentially as we get to this area. 9 EMA above the 21, all moving averages positive, and really the weekly starting to shape up even nicer. I mean, as it always has been, but we're starting to clear this pretty massive shelf right around this area. And if we just draw that and then come back down to the daily, you can see how that's looking. So real large kind of area of supply that we just moved over today on rising volume. So I'd be looking for it to continue to hold over this 25 to 25.50 area for a continued move higher. But that said, we're a little bit too deep into the watch list. So let's take a quick step back and kind of introduce the topic for today. So welcome everybody. Welcome to the lecture. I know I was away last week. I got my first week off of lectures in probably a couple years. So definitely was a little bit different for me there. But happy to be back. And 2 weeks ago, we started the beginner course series for the first time in over a year. So tonight we're going to be continuing that beginner course series. And it's going to be kind of a part 2 of the lecture that we started, which the first topic in the beginners course series is kind of the stock options basics. And just to give a quick recap, I'll kind of flip through the slides real quick. We talk generally about what the stock market is and what are options. So 2 really general and broad questions where we define the stock market, different pieces and larger aspects of it, kind of made some comparisons to different analogies that describe the stock market. And then finally, we got into describing the basics of options. So the different types of options, how they work, different properties of an options contract, some terms to go along with it. We ran through some questions as well. And then, some calculations and things like that. So really just defining kind of the basics of stocks and options, why they matter, what they do, why they exist, those types of things. So if you're interested in those topics, or if you missed the last lecture, I definitely recommend going to check that video out. It should be somewhere in the latest classes tab. So you could go ahead and check that out. That said, moving on, tonight, as I mentioned, we are going to be discussing the Greeks. And again, this is a continuation of our beginner's course series. So just kind of taking a look here. We got about 12 classes here in the beginner's course series, starting with number 1. Again, that was the basics. And tonight we're going to be focusing on stock options Greeks. And the goal of this course is truly to develop successful traders who can find and execute on the highest probability trades and act on those opportunities with confidence. And we've offered this class once before, and I can definitely attest to the fact that this has absolutely been some of the results that we've seen. So yeah, I figured we got a lot of new members now, a lot of people who probably haven't seen this go on live. So what better time to repeat this class than now? And just taking a step back here, quick remarks before we get going and get into the content for the evening. I generally like to run my lectures in a manner where I start with concepts that are generally a little bit easier, and then down the line as we move throughout the time slot, it generally gets a little bit more difficult and a little bit more involved. And that usually serves as a way to get everybody on the same page, as well as kind of warm everybody up to the topic for the evening, because we got varying skill levels in here and all that good stuff. If you guys have any questions, comments, or suggestions as I move throughout the lecture, feel free to throw those in the chat and I will get to those whenever I see them. So let's get right into it. Tonight, again, all we're talking about is the Greeks, and there's really 5 main Greeks for us to focus on this evening. And again, as I mentioned, we kind of recently had a lecture on the Greeks just a couple weeks ago, so I'm not going to go too crazy with defining every single one, and I'd rather instead focus a little bit more on applying the Greeks and really running through some calculations with them, as well as using and introducing some rules on selecting options contracts. So that said, we'll start the night off by just introducing kind of the 5 main Greeks. We'll talk about them, we'll look at them in some examples, and then we'll move over to the charts to see how they actually work. So let's get right into it. So again, as I mentioned, flips in a lecture. Whoa. It's been a while. Hang on. What's going on, Flips?
What's good, brother? How are you?
Dude, it's been a while. I haven't talked to you in a couple of weeks, dude. I'm good. I got back from vacation. I'm feeling pretty good. Just trying to get my feet wet again, get warm back up, and start to get some charts out again tonight, dude. It's been a while, but how you been?
Good, man. Good. Really good. The past couple of days, VC has been in a jam. So very nice.
Past couple of days, man. It's been years at this point.
Now we hit XPX and SPY very nice, and even the one that I thought it wasn't going to be a good trade, it was like kind of sketchy. The volume picked up, and then XPX was pretty. But this, if anybody's listening, this is a lecture that you must see. The Greeks. This is key right here.
Well, hey, Flips, I know you probably won't be around for a while, so I had a little bit of a plan for the lecture tonight. But now that you're here, maybe if you want to give kind of your 2 cents on the Greeks to start us off, that way if you need to go, you can feel free to go. And
no, man, no. I'm all ears for you, brother. You have a plan and it's stick to it 100%. But you should definitely take out a notebook right here. Always.
All right. When we get to selecting options contracts, I'll let you provide some of your kind of rules for that. I know it's generally pretty simple, but it doesn't hurt for people to be reminded of it, as you know.
All right, cool. No problem. I'll be in and out.
All right, sounds good. Cool. So yeah, again, everybody, talking about the Greeks, really 5 main Greeks to be mindful of, right? I'm sure you guys have all heard some of these terms before. Maybe you've studied them on your own. Maybe you've seen them on some post somewhere or some online source. But really 5 main Greeks that matter, which are delta, theta, gamma, vega, and rho. Now, most of these are the most important, but even so, really the 2 most important for most people are going to be delta and theta. And we'll talk about what each one of these means and talk about some examples of both of those. So let's just get right into it. So first off, let's cover delta. Effectively, delta represents how much an options price is expected to change for $1 change in the price of the underlying equity. And one kind of way to track delta in your mind, I guess, is that call options have positive delta and put options have a negative delta, which should be rather intuitive, right? The way you could think about it is if the stock goes up $1, your call option generally would gain value and your put option would lose value, right? Which would make sense, right? Again, stock goes up $1. If your call option has a positive delta, it would gain value. And if the stock goes up $1, your put has a negative delta, it would lose value. One other thing to note is that as expiration nears, in the money calls, delta approaches 1, and with puts -1, and the delta of out of the money calls and puts approach 0. So the closer you get to expiration, the less sensitive contracts will be to moves in stock price if they are further out of the money. So definitely something to be very mindful from if you are day trading, right? For example, let's say, for example, we're trading some, I don't know, maybe today we're trading some PLTR 30 calls, right, which are pretty far out of the money. As we get closer and closer to expiration, the delta will become smaller and smaller, which will ultimately not only make these less significant, but on top of that, the theta will just eat the value away even easier. So something to be mindful of there. Let's see. Does it have to be a dollar or the cents change affect them as well? Scalping. Yeah, that's actually a really good question. And I feel like we could just move right into an example. So let's just take a look at SPY for today. Right, real easy example. And let's just pull up an options chart. What I'm going to do is I'm going to pull out an options chart that is reasonably far away. So let's do like something from May. Let's see. Actually, let's do like July 24/07/31 C, and we'll do something at the money, like a 510 call, which is pretty much right at the money. And we'll zoom in on the 5-minute. Oh, okay, that's too far out, too far out. All right, we got to get a little closer than that. Let's do April 19th. Sure. See if this has a bit more volume. There we go. All right, so here we're looking at the option chart of an at the money call that is far enough out that theta is not going to have an impact. And the purpose of that is really just to make the example as simple as possible. So this option, the way we can think about it is this should pretty much track the exact same as the stock price. And as you can see, if you compare these two charts, they pretty much look the exact same, right? It made a slightly higher low into the end of the day. It made a slightly lower high here, reasonable uptrend throughout the day. So here, essentially, we're comparing the SPY stock price chart to the 510 call options chart. And again, right, as I mentioned, theta should really be not a factor on this one. And let's just take a look at the options chain really quick. If we go to SPY and we pull up the same contract, which this is on Thinkorswim, so those of you who use the same platform should think this is rather familiar. So if we look at the 510 call, those of you who are on mobile might have a little bit of trouble seeing this, so I apologize for that. But I'll do my best to like highlight things as I can. And let's see, I could make this just a bit cleaner there. There we go. So the 510 call, in this far left column, we have the delta, which is 0.53. And let's focus on that, right? And here you can see the theta is 0.13. The total value of the contract is almost $1,000. So a 0.13 theta is effectively not a factor. But the 0.52 delta is what we want to pay attention to, right? And as we talked about in this slide, the delta represents how much an options price is expected to change per $1 change in price of the underlying equity. So if SPY goes up $1, we should expect the price of this contract to go up about 50 cents or the equivalent of $50, right? Because as we talked about in last lecture, options prices are shown divided by 100. So we actually have to multiply 100 to get the real price. And that's the same with the Greeks, right? So this option contract looks like it's $9.75, but in reality, it's $975. And this delta looks like it's 52 cents, but it's actually $52. So let's take a look at the chart from today. So from, let's see, from pretty much this low of day, 508.79 to here, this first higher low. Let's see what we get on the options contract, right? So this is from about 7 a.m. to 7:45 a.m. So starting at about 7 a.m. to 7:45 a.m. here, we got a $1 increase in price. So you can see we went from 508.80 to 509.90. I mean, pretty much a $1 increase, right? Very slightly off, but that's a $1 increase. And you can see here, our option contract started at right around 9 and it moved around to 9:59, right? So as you can see, our delta was 52 and stock price increased $1.10, which we'll just call it $1. And the option contract increased 60 cents or $60, which is pretty damn close to our delta. And we can do that same example from high of low today. So let's run it again. So let's take the absolute low of day here, which was at 508.42, and draw a line to the high of day, which is at 512, which you can see down here in the corner. That is a $3.64 increase. So let's just write that down. 3.6 stock price increase. We should expect a 3.6 times approximately 50 increase in options price, which comes out to, let's see, can I do this in my head? About a 175 increase. I think that's right. 3 times 50 is 150. Yeah. Okay. So we should expect the option contract from low to high to increase about $150. So it starts at 8.9, and at the high of day, it is 10.9. So actually a $2 increase. So you can see there's a slight discrepancy, right? Our stock price increased about 3.6, but our options price increased actually a little bit more than the stock price or the delta said it should have. Can anybody tell me why there might be a slight discrepancy there? From theory, it seems like price should have increased, and really it's probably closer to like 180. But the theory says stock price should have increased, or excuse me, the options price should have increased about $180, but in reality, it increased about $200. Any guesses as to why that might have happened? Cecilio says IV. Mike says theta. John says the other Greeks affected. Absolutely. Yeah. So while delta is the biggest driver of the contract value, it is not the only driver of contract value. And additionally, there's other Greeks that affect the value of delta. So as the stock price goes up, delta also increases proportional to the gamma value. So as stock price goes up, the delta is actually getting larger and larger, which means that this contract actually ended up being rather proportional to what we would have expected, right? And we'll talk a little bit about gamma in just a little bit, but that's the big idea behind delta. And this can be a tool for us to predict price targets for an option contract based on stock price. So let's actually just kind of break this example down just a little bit more. Let's say I'm trading like flips. So let me get my flip study up here. Let's see, I don't know if flips made it back yet, but let's see. Oh, undo clear drawing set. Is this a new feature? I've never seen this before. Does anybody else that use Thinkorswim? Is this a new thing? Those of you who have been to my lectures for a while know that I've cleared the drawing set that I was using so many times on accident, and I've never seen this undo or redo button. Whoa. I think that's new. That's pretty cool. All right, sorry. Little distraction there, but I think that's a new feature. All right. So let's say I'm trading like flips here, and I'm trading a break over pre-market high. And my first target is going to be this 511.66, which is approximately a $1 increase from pre-market high. Actually, pretty much to the tick, a $1 increase in pre-market high. So my entry would be right at 830. So 830, my entry, let's say, is 10.11 right here. So right on that low, right? We get that retest of pre-market high, pretty much to the tick. And if I know my target is $1 higher and the delta of my contract is 52, I could approximately calculate where I should be selling, which approximately, if I'm entering right around this 10.1 area, I could add about the delta to my contract, which would be 10.6. Oops, just happened there. So I could add my delta to the price of my option contract and set a limit right at that area, which would be 10.6 in this case. And you can see we reached the target right around 855. If you look at 855, we pretty much reached the target at the exact same moment. So pretty cool there. It's definitely a really valuable way that you can use to kind of predict where you should be setting limits, buy limits, sell limits. Obviously, this is a little bit of a simplified example, though. I'm looking at a contract out in April, which is over a month of time. And the reason that I'm doing that is, number one, to help simplify this example. But the real reason that it simplifies this example is because a lot of the other Greeks have a much less significant impact when we have so much time on our contract. Our IV fluctuations are going to be less significant. Theta burn is going to be less significant. those two factors alone make it a lot easier to use these further out contracts as an example. But let's say, maybe we were trading things a little bit differently, and let's go with some like, I don't know, some Friday contracts, right? So March 8th, still not same days. And let's try and run the same calculation. So if we go to March 8th and we look at the 5-10 call, our delta is 42. And let's say we take the exact same trade. So we enter at 8:30, which is right here. That'd be our entry. And our delta is 42. So if we look at our entry price here, it's about 3. We would be setting our limit right around 3.4, which boom. And you can see the contract value actually went up a little bit above that theoretical prediction, a little bit more this time around, just because there's going to be a little bit more that impacts it. Right now, we're going to get a little bit more sensitivity to IV. And as a result, we're going to see those impacts in our contract price. And if we look at something like a same day, like a 3-6, let's see how that changes even more. So today's expiration contracts are, the delta is honestly kind of useless at this point because it's expired. So let's look at the in the money. Let's look at the 508, just so it's a little bit cleaner. So the in the money contract was the 508 same day, and that was going for 52 delta. And again, these numbers are just approximate, but let's run the same calculation once again. So entering at 8:30 is right here. So this is our entry, and the delta on this guy is 52. So again, our price target is $1 higher. So our target on the contract should also be 1 delta higher, which is 52. So 2.81 plus 52 is 3.32. 3.32 right here. And you can see this is the same time that we would have sold in the past. However, you can see now where we actually hit the profit target, which was at this time, we would have missed out on a reasonably sized gain, right? We're not actually selling at our profit target anymore. So you can start to see where this kind of calculation breaks down, right? The shorter and shorter we get to expiration, the more volatile the contract's going to be and the larger of an impact the Greeks will have on it. And this is just delta alone that we're looking at here. But you can see very clearly that with all the other examples, if we just simply added 1 delta to the contract price based on our profit target, it was pretty close. And this has actually been the most inaccurate example where we actually missed out on about 10% profit only because we just calculated it based on delta, and there were so many more factors that were affecting contract price than simply delta alone. So reasonably interesting calculation there. What are your guys' thoughts on that? Does that kind of make sense? Are you guys understanding the impact of delta? And oh my God, I just realized it's 6:30. Are you guys understanding the impact of delta and kind of how you can actually use that delta as just a rough idea of where you should be buying, where you should be selling, and a general predictor of contract price? Let me know in the chat. How are we feeling about these examples so far? Rudy's feeling good. Is Rudy the only one feeling good? Do we need to do some more examples of delta, or did that make sense? Speak now or forever hold your peace. We're going to move on from delta. Better understood. All right. Thanks for the feedback, everybody. I appreciate it. I can't read you guys' minds, so I need to hear what you guys are thinking. And if you guys have any questions, let me know. More examples, please. Great. Absolutely. Yes. Let's do an example for puts. Yeah, that's a really good idea. Yeah, let's do puts. So let's go back out to the April expiration here. Just again, to simplify things. So let's go SPY 2404. I think it's, SPY 2404 19, and let's do the at the money put contract. So we'll just call it 510. And again, I'm going far out in expiration and at the money just to make this calculation as simple as possible. So let's take a look at this. Let's say we took a short at this potential double top, right? We top tick price on the day somehow, right? And we set our profit target for the low of day. We were just trading perfectly today, right? So actually, let's see if we can make this a bit simpler. Now let's just do it this way, right? So we set our profit target, or we set our entry for the high of day, and our profit target ends up being the low of day. So the total drop in price here, let's see what we get, is $3.50, right? So let's just write that down. Oops, I can't do anything correctly. 3.5 drop in stock price for our trade. And this right here is the trade that we took, and somehow we were able to sell down at this low a day here. Let's just make this make this a little bit easier for the purposes of our example. 508 point. All right, there we go. So now we could say that we shorted the high day and covered that short at the low day, right? Whatever, right? Just for the purpose of this example. So let's take a look at this contract. So it's the 4/19/5/10 put. So April 19th, 5/10. And if we look at the 5/10 put, we have a delta of negative 49, right? So let's write that down. Let's open this up, negative 0.49 delta. So on this 3.5 drop in stock price, the way to calculate, like here, let me take a step back. So let's say this was our only profit target, is the absolute low of day, which if you're day trading like this, that's kind of crazy that you wouldn't trim it all before then, but that's besides the point. Anyway, let's would be simply multiplying that delta by 3.5. So that would bring us to about a 1.75 increase in contract price, right? Which comes from delta times stock price change. And I'll just write out one more line here, which in this case is negative 0.49 times, or negative 0.49 times negative 3.5. I think that math is right. Yeah. Yeah, that's right. Yeah, that's close enough. All right, so we should be expecting a $1.75 increase in contract price. So we enter these puts at 10:25 a.m., 10:25 a.m. right here. And we sold them at 11:15 a.m., which is right here. And let's see the change in contract price here. So, oh, wow, look at that. That's perfect. So the contract literally increased $1.75 from 7 to 8.75, right? So it literally exactly behaved how we would have expected based on the theory. So this is actually an insane example. I can't believe this just worked out well. Yeah, this is exactly how the put contracts work, right? And this is a really nice example of how accurate the delta can be when you're trading something at the money with a little bit more time, right? As I mentioned, when you have a contract that's at the money and has a little bit more time on it, you're not going to notice the impact of all the other Greeks, right? You're going to see a much more minimal impact from delta, much more minimal impact from everything else, right? Or not delta, theta, IV, et cetera, right? So this is an example based on puts. And again, as we remember, the delta on puts is negative. So when the stock price drops, we should see an increase in contract price, which is exactly what we saw here. Does this example make sense to everybody? That's actually pretty clean. I didn't expect that. Awesome. Worker bee's feeling a little better now. Great idea to go with the puts example. I wasn't planning to do that. The scalp guy, would you recommend trading same day or next day expiration? You're trying to get a nice profit with a 50-cent move, but same expiration, sometimes I get burnt. Yeah, when you're scalping, there's a lot of different ways to kind of structure your contract selection around that. One thing, there's a couple kind of philosophies behind it, right? The first philosophy would be getting something at the money with a little bit of time, right? Because those at the money contracts are always going to have that larger delta. And if you got, a day, 2 days time, you're going to see a little bit less of an impact from the theta. You'll also notice a little bit less of a return. However, if it doesn't go in your favor, it's not going to be as volatile. And then kind of the second school of thought would be grabbing something same day or nearer expiration that's maybe at the money or slightly out of the money. And there's kind of two reasons you choose either, right? If you're looking for a real tiny move, like you're looking for like a 20, 30-cent move, you got to be close to the money. Those out of the monies just aren't really going to do what you want most of the time on a real tiny move. You got to have a move of some significance in order to notice a move on those out of the monies. And really, if you get an aggressive directional move, those out of the monies will juice up quick because they're so far out of the money, they're so cheap that IV really has a significant impact on them. But kind of two schools of thought, or maybe even three there. My personal preference, if scalping, and this is a personal choice, this doesn't mean that it's the right way to do it, is generally having something at the money with a bit more time. And scalping isn't something that I do often at all. It's actually a very rare occurrence for me. Really, River would be the best one to kind of talk to about how he selects contracts for scalping, because he's, I mean, scalping 10, 20 times a day. So I can't act like I have, the best way to do it, because I'm really not scalping very often. It just doesn't really suit well with how I like to trade. So I usually stay away from it. But hopefully that gives you a little bit of understanding there. Generally, it's for me, it's generally swing trading is generally what I like to do. Works a little bit better with me. It's a bit slower. I like looking at the larger time frame, so it just kind of suits my school of thought well. What time frames do I use? Oh man, weekly, daily, hourly, 15, 30-minute, and 5-minute. Nothing below the 5-minute. 5 minutes and 15-minute is for getting entries. Hourly, daily, 4-hour, and weekly are all for trend. So trend's got to be in alignment on all those time frames generally, or at least in alignment on the largest time frames, in order for me to really want to trade. You're welcome. Good question. All right. So that was all about Delta. And I'm happy we spent so much time on that, because Delta really is kind of the most impactful Greek, besides Theta. Before we move on to Theta, I just want to introduce Gamma really quick, which we've kind of hinted at. Gamma is the rate of change as Delta. And for those of you who have ever taken a physics class or have any idea about physics, you can think of Delta as the speed and Gamma as the acceleration. So for those who like to think about things like it's calculus, Gamma would be the first derivative of Delta. So sorry if you haven't heard calculus since high school and today's your first day back. Again, Gamma is the rate of change of Delta. It's generally pretty simple, and I just have this example outlined below. Let's say, for example, our delta is 0.2 and our gamma is 0.1. If the stock is currently at 438 and then increases $1 to 439, the delta goes up by 0.1. Obviously, this isn't necessarily a linear rate. As the stock price goes in your favor, gamma will also probably start to move in your favor as well. And then as it goes in the money, gamma starts to decrease, and it does some funky things. But generally speaking, gamma is the rate of change of delta. If you try to calculate contracts price using gamma and delta, it starts to get a little convoluted. Really, if you're looking to do a crude estimate on contract price, and you have enough time to make it not a same day or next day, generally I would just recommend just doing a simple calculation based on the delta. But you can consider other Greeks if you really want to get detailed with it. But at that point, I'd probably just recommend using like a more formal options price calculator. Does it depend on how fast the stock moves to your target or move up by $1? For this specific Greek, delta and gamma, it does not, the quickness of a move does not matter. I will say, though, the quickness of a move absolutely is factored into an option contract's price in the form of implied volatility. So if a stock moves very quickly in one direction or another, generally speaking, IV will rise. And the Greek that represents IV is shown here, which is Vega. So as implied volatility increases, Vega is going to increase the value of the option contract. But in terms of delta and gamma, it has no care on how quickly or how slowly a stock price goes from one price to another. It simply cares that the stock price has increased or decreased, and that's it. So it's a pretty simple calculation alone. But the overall formula for deriving an option contract's price is rather complicated. And let's see. I mean, I could probably pull it up really quick. Options contract pricing formula. I think there's one. I think I've seen it. There's some like more simple. Is this it? I don't know. This might be it. Anyway, yeah, you could get real funky with it. They got partial derivatives going here, but yeah, not super relevant to know that much about options pricing unless you're like trading like a quant or something. All right, moving on to the second most important Greek is theta. Real simple one here. It's the time decay of an option contract. So it increases exponentially as expiration nears. There's a lot of different ways that people think about theta. There's not really an accepted definition on how exactly theta works. So there's a couple different theories, I'll call it. Some people maintain that some amount of overnight theta is applied before the market closed. And just to take a step back, theta is working 24/7 against your option contract's value. So again, similar to delta or gamma, it is a set value. So right now, the theta on this 509 call that expired today is 0.91. So yeah, it's going to be worthless. On this March 8th, 509 call, it has a $1.11 theta. So in theory, if the stock stayed flat for 24 hours, this contract would be worth $1.11 less. So theta is over a 24-hour period. But again, a couple kind of schools of thought around how theta actually works. Like I mentioned, some people think that some parts of theta are priced in throughout the day. So, like, there's going to be theta that occurs overnight. So that starts to get baked into the price throughout the day. There's some people that think that it's not the case. And yeah, so there's not really a unified understanding, I don't think, of how theta works, or at least that was the case the last time I researched it, which at this point was about a year ago. But really, the most important thing for you to understand is that theta essentially represents the rate of decay of your options contract. And again, this increases exponentially as you near expiration. And we can even visualize this here if we look at the options chain. So if we look at the theta on a April 19th 510 call, it is about $14, right? If we look at it for a couple weeks earlier, March 19th, the same 510 call now has a theta of 23. Then if we look a couple more weeks closer, right, now it has a theta of 41. And 2 days out, it has a theta of $1.05, right? And this increase might seem trivial. However, if you think about theta as a ratio of the overall price of the contract, it's even more significant, right? Like, you might think that a theta increase from 14 to 23 it's not really a big deal. However, the price of the contract has dropped in half, right? You have a 14 theta on a contract that's almost $1,000. You're losing about 1% a day. Whereas now you have a 23 theta on a contract that's almost $500, right? Now you're looking a lot closer to 4% a day of your contract is evaporating. Then you zoom into just 6 days out. Now a $400 contract is losing 41 theta a day. So 10% of your value is decaying a day. And then if you look at a contract with 2 days till expiration, it's a $240 contract with a buck theta. So you're pretty much losing 40 to 50% of your contract in a day if you just hold it and the stock price stays flat. So something important to really be mindful of, the theta as you get closer and closer to expiration only continues to work against you even more. And that's kind of why it can be real difficult to hold same days when they're not going in your favor, because that theta is just eating away at the price of your contract. So something to be mindful of, right? That's why so many people say same days aren't really meant to be held all day, because if you don't go in the money quick, you're going to start noticing that decay. Or if you don't get a move in your favor quick, you will notice the decay. I mean, in the span of 15 to 30 minutes, if the stock price stays flat, you're going to be down 100% of the time. So something to be mindful of there. Any questions on theta? I know this example was reasonably simple, but all it really is I guess the way to remember theta is it's an options buyer's worst enemy, right? Because we're just losing value on that contract simply by holding it. But it's actually an options seller's best friend, right? Because if you're selling options, you want the price of the contract to go down. So a little bit of food for thought there. All right. So moving on, this next example really should actually be, at this point, not AMC. AMC is no longer very volatile, but rather SMCI. So Vega represents the rate of change in an option price per 1% change and in implied volatility. And I have the question here, what is implied volatility? And I want to kind of pose that question to you all. Do you guys have any idea on what implied volatility actually is? Does anybody kind of have any ideas on what that might be? Okay, so we got one answer based on either volume. Implication of volatility based on news. Uh, your BFF or your worst enemy? Yeah. All right, Norvin. Nice. Cool. So yeah, some decent answers there. Implied volatility essentially shows the market's opinion of a stock's potential moves. It doesn't necessarily forecast direction though. So if the implied volatility is high, that means the market thinks the stock has the potential for a large price swing in either direction. Just like low IV would imply the stock won't move much by the option's expiration. And we could see this visualized in the option chain. So you could actually see the IV illustrated here. So right now, the market makers think by March 12th, the SPY could move $7.22 higher or lower. And if we look at something like SMCI, and $7.22 is about 1-ish%, we'll say, right? So about 1% by March 12th is what the market thinks that SPY can do. And if you look at, let's actually go to a standard expiration. So the 15th of March, the market thinks that SPY could move $10 up or $10 down, which is about 2%. We'll call it whatever, right? 2%. If you look at something like SMCI, right? By March 15th, the market thinks this can move up or down $200, which is closer to 20%, right? So the market thinks SMCI can move 20% in the next 9 days, but it thinks the SPY can move 2% in the next 9 days. So you can clearly see that the implied volatility on one name is much greater than the implied volatility on another. And even looking at another semiconductor stock, right? ARM, right? Implied volatility here is $21. And let's think, that's a little less than 20% of the stock price here. That's closer to like 15%. Sorry, I'm doing all this math in my head trying to make it work. So implied volatility, the higher the implied volatility, the more expensive a contract will be. And you can kind of see this illustrated here. Well, this isn't the best example, but let's just look at something that's, I don't have any great examples of that. But generally speaking, implied volatility will increase the price of option contracts. And that's kind of why even Norvin has a good point. It could either be your best friend or your biggest enemy, right? For something like SMCI, if you're purchasing option contracts with at this high of IV, if the stock stays flat for a day, you're going to lose money. And it's not going to be just Theta that's taking your money. It's now going to be IV and Vega that's going to be dropping the value of your contract. Whereas if you're in a contract before implied volatility hits, then you're actually going to be at a massive benefit because the price of the contract will be increasing while you are in it based on not only IV, but also Delta. So kind of two ways to think about it. Me personally, I never check like the Vega before I enter. It's just not something that's something. It's not something that I do. It's generally not a bad idea to take a look at the implied volatility before entering a specific contract. You want to be mindful of what you're getting yourself into, because ultimately, right, the lower IV, the better value you're getting for what you're purchasing. So if you can, it's ideal to avoid expirations with higher IV, which sometimes you can see when like a stock has earnings. It's usually pretty obvious. Even the SPY, pretty interesting here. If you notice, today's IV is 15.16%, whereas the next 2 days, the 7th and the 8th of March, have 16% IV. And then if you look at the 11th of March, it drops all the way down to 12% IV. So actually, just based on IV alone, this 11 March expiration actually is one of the best bangs for your buck based on IV alone, right? Obviously, there might be other factors to consider when purchasing a contract, but this is below the kind of average IV here, 12.2%. So yeah, something to be mindful of there. And you can kind of see that illustrated throughout the options chain, right? You can see those swings in IV where you go up to 16% here for this expiration, right? This is the March 15th expiration is 16%. So you might want to stay away from this March 15th expiration, right? It's got a lot higher IV for some reason. I mean, it is the standard expiration, so that might be part of it, a little bit more liquidity there. But yeah, that's Vega. All right. The final Greek to talk about tonight is rho, which is the most useless Greek, and you will never look at this. It measures the expected change in an option price based on a 1% change in interest rate. You're never going to look at this. Interest rates don't change that much, especially right now, and rho is not something that you should really care about ever. So I'm not even really going to talk about it that much. Yeah, you really don't ever need to check rho unless you're looking for some kind of arbitrage trade or some other kind of, I don't know. It's not something that I would ever really care about. Cool. So yeah, let's move into a little bit about picking a contract. I want to just introduce one other concept really quick. There's a lot more options Greeks that we didn't talk about today. And we just talked about kind of the most standard ones. But there's another set of options Greeks, and these get really, really kind of detailed. It's they're called Vanna and Charm, and there's even more than that. There's a lot. These are like the second order Greeks. So yeah, Vanna, Charm. There's like Vera, Veda, and some other stuff. It's pretty much all the like second derivatives. It's yeah, it gets really, really, it gets really detailed. But yeah, it's just something to be mindful of. There's more Greeks than what we even introduced tonight. Some of those Greeks can be a little bit more relevant than others. So something if you want to do some research on your own, so you can be mindful of that. So talking about picking a contract, right? There's a couple general rules of thumbs for you to be mindful of. And it's things that you should always be thinking of when you're selecting a contract. It's important to note that there's not really any one size fits all. Although these are like general ways to guide your contract selection, these don't mean that this is exactly what you should be trading every time. For example, you could scalp a contract with 2 weeks of time if it's at the money, right? You're still going to make some money on that. And you could day trade any contract. You could day trade a contract with 2 weeks time if you want to. And you could also swing a weekly expiration contract if you want, right? It doesn't mean that you can't do that. But you have to be mindful of why you're doing that, and you have to have good reasons to be doing these types of things. So let's talk a little bit about these just general rules of thumb. So generally speaking, when you're scalping, you're going to be trading either daily or weekly expiration contracts. When day trading, which is going to be when you're holding a trade for a bit longer but still selling within the same day, you could have up to a 2 week expiration contract. Generally speaking, when you're swing trading, you're going to have something with a little bit more time. And there's a reasonable reason. Oh well, that was bad. There's a good reason for all of these rules of thumb. For a scalp, you generally want contracts that are a bit more sensitive to price. So this could look like things that are closer to expiration. These could also look like things that are closer to the money. These could also look like things that are close to expiration and out of the money, right? So the general rule behind scalping is you want contracts that are going to be sensitive to moves in price. Next up, again, day trading. You want contracts that are going to be sensitive to moves in price, but also are a bit protected from decay from theta, right? So that's a general idea behind day trades. And then swings, you want enough time, right? This is where you really want that protection from theta decay. For swings, you'll generally be looking for a bit larger move in price. So you're not as concerned about the sensitivity to price, but rather you're concerned about the sensitivity to time. So you really don't want to be swinging something that's going to be expiring in a day or two, because if the stock's flat, there's a good chance you're going to be down a large chunk of change by the market open. So all things to be mindful of there. We could just talk through a couple different contract selections for today. So you can kind of see all the examples that I chose today were either at the money contracts or same day contracts in order to illustrate what an option contract would do based on a intraday move, right? And all those option contracts were selected for a reason, right? I knew there'd be a tradable, reasonable move in every single one of the contracts that I pulled up today, right? So when I'm looking at these April expiration contracts, they are close to the money, and you could very easily scalp this April expiration contract on this move lower, right? Is it something that you'll see done every time? No, absolutely not. I mean, it moved great off this one move back into pre-market high. Like if you're looking for a rejection based on this double top and you wanted to scalp something, I mean, this great gave a real nice move. I mean, this was a 70 buck, 10% move in contracts. I mean, nothing wrong with that, right? Not a damn thing wrong with scalping that. But obviously it's a little bit more uncommon, right? So when you're scalping something with this much time, you have to think about your percent return, which in this case, it was a 10% return. If we drop the time till expiration down to March 15th and we look at the exact same move, we get about a 20 to 30% return on pretty much the same move, right? We'll call it 20%. So you have to be, yeah, obviously, this is a cherry picked example, right? Important point to make there, Rudy. Obviously, it's easy for me to look and show you the move on a contract in hindsight, but this still helps to illustrate kind of why you should be selecting different contracts. Like, for example, if I go far out of the money, like if I drop down to like a 490 put, On the same move down, this thing still ends up going up 10%. But for this March 15th expiration, it's super unreasonable, right? It doesn't really make sense. Now, obviously, if you held for the whole move, I mean, this thing actually ripped. It did 60%. So sometimes, again, on those larger moves, those out of the monies can pay. We get that move in IV, and it works in our favor, right? But if we look at something even closer to expiration, like a 3.8, 490, this thing probably did nothing. Yeah. So this thing did absolutely nothing. I mean, I don't think anybody even really traded it. You might have been able to sell that. Yeah, it did 180% apparently, but there was 12-ish, maybe 15 contracts traded throughout this period. So I don't really think it was possible to catch that move lower on this contract. So that's one thing to be mindful of, right? Think when you're selecting your options contract, you need to be mindful about the type of trade that you are taking, right? There's a time and a place for every type of contract. And you can't just be picking whatever contract you want just because you feel like it. And if you really want good examples of kind of day trading those contracts, I couldn't recommend more listening to Flips in the mornings. I mean, the guy is on point with the day trades that he takes. And yeah, he's always selecting pretty much close to the money, but short-term expiration contracts. I don't know. Flips was in here for a bit, and then I think he went and he didn't make it back. So I don't know where he ended up. This is where I wanted him to contribute, but he had to go. So all good. The last thing that I want to mention is something that I talked about in the last lecture. Another way to select option contracts is paying attention to volume and open interest. Generally speaking, you want to be trading contracts with high volume and open interest. What that means is that the rest of the market is also interested in the same contract that you are trading. So for something like, I don't know, let's look at like Netflix. For something like Netflix, right? We look at the volume interest and open interest. We could see that there's 189 volume and 194 open interest on the 597.5 calls, which means that not really many people are trading this. If we look at the very next strike, the 600s, we have 700 volume and 22.1K open interest, which just means that there's a larger amount of liquidity. It's going to be easier for us to buy and sell this contract. The volume, again, represents the number of contracts traded in a day, and the open interest represents the number of contracts that actually exist. So things to be mindful of there. Those are just some kind of general rules of thumb. But really the best way to figure out how to select option contract is, number one, paying attention to specific examples on how other people do it. So for example, if you're taking an analyst trade, go ahead and ask why they're selecting the contract they do. Like if I'm posting a trade and selecting a contract, ask me, well, why is that the contract that you're looking to trade? Or if Flips is taking, an at the money contract and it's a same day, ask him, well, why do you think same days? And he'll probably say, well, we always trade same days. But that's really the best way to learn on how to select contracts is you got to just do it. You got to just get your reps in selecting contracts, figuring out what works and what doesn't. Yeah, that's a big idea. Any questions on these topics before we call it for the evening? All right. Well, if there's nothing else, we'll recap what we talked about today. Yeah, I'll check those tickers, Marvin. So yeah, today we talked about the Greeks option contracts and how to select an option contract for a specific trade. Rudy, what happens when you buy in the money? Yeah, good question. Yeah, so buying in the money, again, is just going to continue to maximize your delta. As you get deeper in the money, your delta goes up, and it's also going to minimize your theta, right? So you can see the deeper we go in the money, the larger the delta gets. And it gets to the point where you go so deep in the money, it's pretty much the same thing as buying shares. Obviously, as you go deeper in the money, the price of the contract gets greater and greater. So there's kind of a limit to how deep in the money you should really go. If you're going like 10, 20 strikes in the money, it's probably, not a great idea. But generally speaking, if you're in the money, your theta is going to be less significant compared to the contract price, and the delta is going to be larger. So you can kind of see that here illustrated, right? You can see as we get closer to the money, theta increases, and as we get deeper in the money, theta decreases, right? You can really see that nicely here, right? We go from 0.2 to 0.3 to 10 to 50 to 70 to 75, and then that theta starts to drop off as we go deeper and deeper in the money. And the reasoning behind that is the extrinsic value is much less significant on contracts deeper in the money. It's more about the intrinsic value at that point, which those are two contracts that we talked about last time. So yeah. All right. How how do you know the open interest on buying or selling calls? Yeah, so in Thinkorswim here, it's just displayed in this kind of tabular format here. On other brokerages, it's also displayed as well in different ways, like Robinhood shows it, Thinkorswim on mobile shows it. I'm sure every other, like Webull, you could see it there in the options chain. It's all displayed there. And in terms of how do you know if it's bearish or bullish, you don't really always know. Like just by looking at volume open interest, you can't always really make a decision if that's bearish or bullish. It's really important to see the transactions that got that number there. So if you could see, like, if a lot of people were buying those contracts above the ask, it might be a bit more, it's probably going to be a bit more bullish, right? There's a unique interest in buying that specific contract, which probably means it's a little bit more bullish than bearish, right? And same thing goes for a put, right? If there's a unique interest in buying that specific put above the ask, it means people are aggressively buying that specific contract for some reason, right? So people have a specific interest in that contract. Generally speaking, though, a contract with high open interest and high volume just shows that it is a interesting contract to the rest of the market. It's going to have good liquidity. It's going to be easy to buy and sell. And that's exactly what we want when we're trading options. Awesome, Twisted. Very, very good to hear. Yeah, feel free to reach out if you have any questions on those. All right, Norvin, it's your time now. Norvin hasn't been in class in a while, so we get to talk about some of his favorite stocks. Norvin, I'm not going to lie. I was actually looking for an entry on a VRT, but I totally blew it. I was, being on away, and I wanted to enter right here. Actually, I saw it reclaim the 62 area, and I was like, oh, I should get in, but I didn't do it, and now I'm sad. So, Norvin, I've given you 3 entries long. I gave you this entry in January, this entry in January, now this one in Feb. Let's see if I can give you the next winning entry. I mean, you take a look at the chart. It's still the exact same thing here. Sellers continue to be pretty much non-existent. We have buyers dominating price over and over with any unusual days. Let's see. Let's kind of draw some more pivots here. So we got a key level right around that 65 spot. And that's pretty much it for that. We zoom in on the hourly now. Let's see. Oops. Let's go here. There we go. That's better. All right. So yeah, key level right around that 65 for sure. Another key level at the 68. So it looks like the big one. And then now the 73. And a decent amount of sellers there yesterday. All right, Norvin. This is my next alert for you. So we got a long entry long. And today is 3/6/2024. There you go. Above the green line, you get long. Oh, no, I canceled. Yeah, above this green line, you get long. Okay, here we go. Beautiful. And in terms of another entry, I also like this one. Yeah. There you go. So 2 entries here, above the 73.50 spot, back down to the 70 area. Take your pick. There you go, Norvin. All right, Marvell. Yeah, this thing's a ripper. I'm pissed about this one. I don't know, man. I mean, they got earnings, tomorrow? Yeah, I don't know. I mean, it probably rips. Why would it not? I mean, it's probably going back to them highs. That's what you got to think, right? Yeah, I missed it though. Yeah, there's no entry here for me, but it probably is just going to rip, right? I mean, why not? Yeah, I'm not touching it, but it's probably gone. If it comes back to 70 though, probably buy it. All right, everybody. I'm going to call it here. Hope you actually trade that entry this time, Norvin. I've given you 3 so far. You haven't traded a single one. Now you got 2 more. So hopefully you hit them. All right, everybody. Thanks so much for your time today. I'm going to call it for this one. And I will see you guys all in the next one. Thanks again. Hope you guys enjoyed. If you guys have any comments, questions, suggestions, or feedback, you guys know where to find me. Please reach out. Send me a DM. and I'll see you guys all in the next one. Thanks again for your time. See you guys.